Well, State Bank of India has posted a stellar set of numbers for the second quarter, beating street estimates. The bank reported its highest ever quarterly profit of over 13,260 odd crores, 74% higher compared to last year, and an NII growth of 13% YOY. Advances also grew by about 20%, and asset quality saw an improvement as well. Gross slippages falling to about 2,400 crores from over 10,000 crores in the previous quarter. We have with us the man of the moment, Mr. Dinesh Khara, Chairman of State Bank of India, joining us to take us through the fine print of these numbers. And also joining me from the Mumbai studio is Abhishek Kothari. Mr. Dinesh Khara, thank you very much for being with us here. A stellar set of numbers, like I was saying, from SBI in the second quarter. Now, what next? What could you tell us in terms of the growth outlook as well as the asset quality? Will this kind of trajectory sustain where your gross NPAs have already fallen below, are now at less than 1% net NPAs and gross NPA at around 3.5%, slippages quite low? What could you tell us about the outlook?
I think I would like to say that the kind of growth numbers which are there, partly it is also a function of the busy season which you have just closed. So I think going forward, I still expect that the credit growth should be somewhere in the range of about 14 to 16%. And as far as the credit quality is concerned, over the years we have strengthened our underwriting processes quite a lot. So which has helped us in mitigating the credit risk which was there in the balance sheet. And hopefully we should be in a position to maintain this kind of a credit quality going forward. As you are aware that the book is about 54% is now 52 to 54% is now retail. Very important component there is our ability to reach out to the customers in time. So we have recently started our call center, which is state of the art. So which has helped us in reaching out to the customers, and the pre-delinquencies calls have become a reality, and that has helped in the past also. Our NP ratios in the retail was much lower, and even in the corporate side also, as I mentioned, the risk management has been strengthened quite a lot. The credit review department which evaluates each and every credit proposal thoroughly, that also give their input. So these kind of better underwriting practices also has helped us in achieving the kind of the credit quality which we have done. Agriculture and SME also our effort is to go for even CGTMSE loan, even vendor financing, where there is a clear visibility in terms of cash flow. So that has also helped us in improving our underwriting in the SME sector. And I think overall all sectors we have seen the improvement in quality of advances.
We'll come back to the advances growth later, Mr. Khara. 15 to 16% advances growth target for the year. But let me come back to asset quality, because your SME 1 and 2 book, that has increased over the previous quarter, now at around 8,497 crores. What led to this kind of an increase, and could you give us an outlook going forward? When do you see this reducing meaningfully?
What is happening is SMA 1 and SMA 2 is a position as at a point of time. So out of this, normally we pull back, and naturally on the day of the balance sheet we see these numbers, but we invariably pull back these numbers. Out of this, so I remember 1,700 crore was one of the slippage which happened, but we have already pulled back that account also. So similarly in the retail also, the amount has been pulled back. It is almost the responsibility of the teams which are doing the collections on a regular basis. So I think I don't perceive it to be a major challenge, because the very major component of that is into the SMA 1, which gives us the room for recovery as well. So I think we should not have much of a concern relating to SMA 2 and SMA 1 and SMA 2. Only requirement is that we should stay focused on these numbers and ensure that we're in a position to pull back.
Well, the advances growth was quite good for the quarter, almost 20%, and you're guiding for a 15 to 16% growth for the year. Where will this come from, if you could break up for us from the retail and the corporate side? Within corporate, working capital, project loans, and within retail, which sectors are showing promise?
See, we have got visibility of either proposals in pipeline or one which are sanctioned already, awaiting disbursement. So all that is somewhere in the range of about 3.5 trillion plus as far as the corporates are concerned. So I expect that going forward, the kind of availment which has happened from corporates in this quarter will have the visibility of similar availment going forward, because corporates are earlier raising money from overseas markets. Now overseas markets have turned expensive, and with the hedging cost, perhaps it is much cheaper to borrow from India as compared to borrowing overseas. So that is something which is, I believe it will help us in seeing the decent corporate credit growth also, apart from the retail credit growth which you have seen all this while. And infrastructure continues to be a major focus area. And apart from that, the renewable energy is another very major area. And the PLI has also started showing good demand. So I think overall I expect that that is one of the reasons why I've indicated that we should be in a position to see 14 to 16% kind of a credit growth.
Well, Mr. Khara, this is Abhishek Kothari this side. To begin with, you spoke about the credit growth. Now let's focus on the liability side. Is deposit growth a challenge for the system as a whole? What would your view be on the deposit growth trajectory for the system and for your bank?
See, as far as we are concerned, we have got some investments which are likely to be up for redemption in the current year, and it is as high as about more than 3.5 trillion as on 30th September when we have compiled these results, though it is even on the higher side now. So I think we would be in a position to unwind these investments and support the credit growth as and when this kind of a visibility will be there. And apart from that, at a system level also, I think the government, normally we expect that the spending from the government will also go up somewhere towards December, January. And that will also bring in more money into the system, and which will also address the liquidity requirement of the banking system.
So, sir, one question on the net interest margin. It improves sharply on a sequential basis. So, can the upward trajectory in your net interest margin continue in a rising interest rate scenario?
In the net interest margin, we have got one small exception, which is 592 crore is the interest on income tax refund. Though last year on a YOY basis it was 1,792 crore. So I think this is one area which may not be there, but otherwise I expect that considering the lag in the interest rate when it comes to deposit repricing and also the asset repricing, I think we will have a reasonably decent opportunity to have decent margins.
So one of the business segment which stood out was your overseas business. Now there is slowdown in exports that we know. Do you see foreign business momentum to slow down going ahead?
We have got about almost about 60 billion balance sheet, overseas balance sheet, $60 billion, and out of that $60 billion, it is equally split into the local financing, the trade finance, and also the borrowing, which is ECBs. So I would say that if at all this is the kind of a growth which we have registered in rupee terms, but if we look at the dollar term growth, it is about 18%. So I think as far as the ECBs are concerned, we expect it to slow down a bit. But as far as the local borrowings are concerned, and also when it comes to the trade finance, I think those opportunities are normally in the overseas geographies, and our major geographies are USA, UK, and Hong Kong and Singapore. So these are the major geographies where we are lending. And apart from that, TCBs we are normally parking in the gift city. So that's how the whole split is. So I think what I expect is that as far as the USA and UK are concerned, there should not be any major challenge, and because we are in any case, we are participating in the syndicate deals. We are not as much into the bilateral deals.
Okay. Just another question on your NCLT portfolio. Any resolutions, or what kind of resolution momentum do you see over the next 6 to 12 months?
Yeah, we are, see, now there are multiple agents which are at work. So that is multiple agent. When I say multiple agent means NARCL is also active, IBC is also there, even OTS and the compromise proposals are there. So it is not necessarily NCLT, but the various other options are available. And we have already seen in our OCA book, we have seen a decent recovery this quarter. So I think overall, I expect that this is also much in focus, and we are exploring all possible opportunities to resolve our NPAs and also our OCA book.
In that case, Mr. Khara, could you give us a sense on what kind of recoveries and upgrades you're expecting through the rest of the year?
I think we have set a target for about 10,000 crore worth of recovery from the OCA, and we should be in a position to achieve that kind of a number.
Okay, and
NPAs in any case, I think. Sorry, please go ahead.
Sure. With the kind of growth that you've projected, would you require any fundraising in the near term?
I don't expect, because we have not plowed back our profit as of now, and we expect that somewhere around 25 to 30,000 crore kind of a plowback should be there at the end of financial year, and with that kind of the plowback, will be in a very comfortable position. And even now also, the kind of growth which we are expecting, we have actually done some extrapolation, and we can support that growth.
And, finally, Mr. Khara, the last time we spoke, you did mention that your plans to take the mutual fund subsidiary public is on hold. When do we see you moving on that front? And what is the reason, other than, of course, we're seeing a bit of a choppy market right now, that you're not exploring this route as of now?
See, essentially, asset management companies are asset-light industry. So as such, the company does not need capital. But so that is the reason why it's a very well nurtured entity, and we'll wait for the right and opportune times when we should think about it, and that is the point of time when we will plan, if at all we will plan for it.
All right, Mr. Khara, thank you very much for speaking to us and taking time out for us here at CNBC TV18. Pleasure speaking with you.
Thank you very much.
All right, on that note, we have to slip into a short break, but don't go anywhere. We're back with more numbers from Bank of Baroda and other FMCG companies, so stay tuned for that. Welcome back. This is Business Saturday. Let's shift focus to some other earnings that we're tracking today. Bank of Baroda reported a strong set of second quarter earnings, improvement in asset quality and top line as well. Abhishek Kothari gets us the fine print. Abhishek.
Well, it's a strong set of numbers coming in from Bank of Baroda. The ROA, or return on asset, is above 1%, perhaps for the first time that you are seeing in last 7-8 years. The ROE has come close to 20% at about 19.6%, which is one of the best in last 7-8 years. They have got the highest ever quarterly profit of more than 3,300 crores. So the net interest margin has been pretty robust. It's one of the highest that you are seeing in last 30 quarters, coming in at close to 3.33% when compared to 3.02% in the previous quarter. Domestic net interest margin has also improved, one of the best in last 30 quarters, coming in at 3.41% when compared to 3.07% in the previous quarter. Even their international net interest margin has been pretty robust, perhaps for the first time that you are seeing an Indian lender getting a net interest margin on their foreign operations above the 2% level. So it's come in at 2.17%. The gross NPA ratio is one of the lowest that you are seeing in last 29 quarters, coming in at 5.3% versus 6.26% in the previous quarter. Net NPA ratio is the lowest in last 30 quarters, coming in at 1.16% when compared to 1.58% in the previous quarter. There has been robust loan growth of about 19% YOY and about 4% sequentially. This is largely been led by the international loan growth, which is around 41.65% YOY and about 8.6% quarter on quarter. So quarter on quarter, the domestic loan growth is just 3%, a beat on the NII and PAT to our poll. Strong earnings coming from Bank of Baroda.
All right, thanks for that. That was Bank of Baroda. Now from banks to FMCG then, Britannia delivered a strong set of second quarter numbers, reporting a beat in net profit, revenues, EBITDA as well as margin. Now Britannia posted its highest ever quarterly revenue at over 490 crore rupees for the quarter. The company was able to clock in a margin of 16.3% compared to a 15.5% margin on a year-on-year basis. Now, Marico, that also delivered a mixed bag in the second quarter with net profits coming in below expectations, even as the FMCG players' revenue, margin and EBITDA numbers largely were able to meet what the street was expecting. Marico also clocked in 3% growth in revenues on a year-on-year basis, while margins came in at 17.4% compared to 17.5%, again on a YOY basis. And we also saw Titan report its numbers, an all-round beat in the second quarter from Titan as well. The management noted that the watches to jewelry maker delivered a 17 to 19% growth during the festive season. Now, this has helped the revenue of the company grow by over 20% higher on a year-on-year basis to more than 8,700 crore rupees, and the net profit also rising to more than 30% in the second quarter. And finally, the last set of numbers, TVS Motors' second quarter earnings largely missed the street estimates, with only revenues coming in above expectations. Now, Chennai-based automaker TVS, it also saw a 47% jump in the net profits, even as margins were flat on a year-on-year basis. The revenue, meanwhile, came in at nearly 30% higher over the same quarter in the year-ago period. We'll also then get you a quick wrap on the global markets then. The European markets ended Friday's trading sessions sharply higher, with the French CAC and the German DAX over 2.5% higher, and the British FTSE closing with gains of over 2%. The US market also ended the week higher, with the Dow Jones surging 400 points, the S&P 500 points, and the Nasdaq Composite Index ending nearly 1.5% higher in trade. Now, staying with Wall Street action, the US non-farm payrolls data that surged by over 260,000 in the month of October, much higher than estimates. The unemployment rate ticked up to 3.7% from 3.5% a month before. CNBC's Rick Santelli filled us in on this report.
October jobs report to show us roughly 200,000. It's a beat, 233,000 non-farm payrolls. But there's a bit of a fly in the ointment here. 233,000 is private payrolls. Non-farm payrolls is 261,000. And the fly in the ointment is that 263,000 in the rearview mirror and 263,000 back in April of 2021. Those were the low water marks, meaning that we've now made the lowest level of month-over-month non-farm jobless expansion since December of 2020, when it was actually minus 115,000. So 261,000. If we look at manufacturing payroll, 32,000. The unemployment rate moved up to 3.7%. It was at 3.5%, which is the best it's been. So up to 3.7, that would mean the highest level since February of this year, when it was at 3.8. And if we look at the average hourly earnings, maybe some of the most important data today, it's up 0.4, a bit better than expected. We had up 0.3 for the last 2 months. Prior to that, in July, it was up 0.5. So this is the best since July. And if we go a little broader and go year-over-year outlook on earnings, it's up 4.7, exactly as expected. But do keep in mind, this has been drifting lower. Now, if we go pre-COVID, it was 3.5%. But 4.7% is the lowest level on wages year over year, going all the way back to August of 2021. August of 2021. Average hourly work week, well, pretty much 34.5 shows up just about every week. This is the third month that we've had 34.5 on the work week. And maybe the second most important aspect of this data series is labor force participation, because that number kind of helps explain how many people have disappeared. And it ticked the wrong way, 62.2. We're expecting 62.3. The best it's been post-COVID was in August at 62.4. So we've now dropped a tenth every month for the last 2 months. And if we consider where we were pre-COVID, we're at 63.4%. So we're really starting to expand that spread. The underemployment rate, or U6, which goes against the 3.7 on U3, also moved up to 6.8. Last month, 6.7 on underemployment was the best, so it was best of breed post-COVID. And if we look at pre-COVID, it was 7%. So, taking a step back, let's let the markets tell us what it thinks. 10-year note yields moved from 4.15 to 4.19. So that's fascinating. And if we look at the week-over-week numbers, they're very large, Joe. 477 now in a 2-year. 477, which means it's up 35 basis points on the week.
Well, Egypt is all set to host the pivotal climate summit starting this Sunday. Ahead of the 2-week-long summit, the UN has warned that global efforts to cut emissions is woefully inadequate and the world is on track for a catastrophe. Radhika Udas and Arundhati Ramanan reported on the key issues that will be debated at the annual climate congregation.
198 countries will gather in Egypt's Sharm el-Sheikh to attend COP27. That is the 27th conference of the parties to the United Nations Framework Convention on Climate Change. The delegates will discuss the collective global goal to combat the climate crisis and present their action plans to contribute to these goals.
The heartbreaking scenes from Pakistan and the untold suffering of tens of thousands of victims of this climate calamity, the unprecedented rise in temperature and forest fires in Europe and the United States all confirm that there is no plan B and that the last U-turn is only a few kilometers away.
At the crux of COP27 lies the aim to reduce rising global temperatures. 1.5 degrees Celsius is the target that the nations had promised to work with at COP26 in UK last year. However, the United Nations Emissions Gap Report reflects otherwise.
The report notes the current policies in place are looking at 2.8 degrees Celsius rise by the end of the century, as opposed to the target of 1.5 degrees Celsius. According to the report, India is among the top 6 countries where emissions have increased after the COVID-19 pandemic. The report also goes on to highlight that G20 members account for 75% of global greenhouse gas emissions.
Is that a number of countries raised their national commitments, and then a number of corporates and financial institutions also made strong commitments to ramp up ambition in terms of CO2 emissions reduction. What unfortunately hasn't happened that much since then is the development of implementation plans to ensure that countries and corporates actually achieve the commitments that they've made.
Staring at bleak numbers, COP27 this year is an important assessment of progress on commitment to net zero emissions by 2030 or the lack of it. At the COP meeting, India will demand clarity on the definition of climate financing and how it should be disseminated. In Mumbai with Radhika Udas, Arundhati Ramanan.
On that note, we have to wrap up this show, but stay with us. The news and updates continue right here on CNBC-TV18.